So, Robert, another busy week we had. One of the first things I want to talk to you about, the fact that the Fed raised interest rates again as expected. Can you put into perspective what this would mean for the average person in terms of what kind of a pinch this puts on the average person?
Right. In terms of consumer impacts, one thing we're going to see is any type of consumer credit item, a little bit of upward pressure on credit card rates, a little bit of upward pressure on auto loans, and then also mortgages for those with variable rate mortgages. Those will be adjusting up through this year according to their own plans. And then also for those who are new home buyers looking at fixed rate mortgages, those will also be coming up. So when the Fed increases the Fed funds rate, it's tapping on the brakes of the economy. And we can think of these as little taps that the Fed is giving the economy right now to prevent it from overheating, keeping an eye on inflation.
What do you think is most important that we should know about what's happening right now?
A pretty good expectation, pretty consistent expectation that the bill will add to the federal deficit over time, and that requires the Treasury to issue more bonds and borrow more money, and increasing the supply of bonds drives interest rates up. So in addition to the Federal Reserve increasing rates at the short end with the Fed funds rate this week and ongoing increases this year, we're also seeing a little bit of pressure on the long end as the federal government agrees to spend money and has to borrow the funds it needs in order to do that.
Other things affecting our economy, the Trump administration clarified its stance on tariffs with regard to steel and aluminum this week. Now, how does that change the overall picture?
President Trump has said that he will exclude Canada and Mexico and the European Union and several other countries, Australia, North Korea amongst those. So it really means the first round of tariffs on aluminum and steel are really focused on Asia, China in particular, and Russia will also fall under that group. And then also the president has indicated he is looking for more tariffs specifically on China. And so there's really two separate issues going on here. And then China has also indicated that they will retaliate, and we'll have to see where this ends up. But in the short term, it does look like there will be some higher prices, a little bit upward price pressure on imported goods due to the tariffs, and a little bit of pressure on U.S. exports due to the potential for retaliation. So this is an economic lever. I think the overall U.S. economy right now is in good shape with plenty of momentum and certainly can withstand the pressure, but we'll have to see where this goes as well.
New home sales, we seeing the numbers are down, but existing home sales are up. So what do you make of that?
Well, existing home sales are certainly the bulk of the market, and even though we did see a little bit of a drop in new home sales, revisions were good there. And what we're looking at right now is we're really looking closely at the housing market to see if the rising mortgage rates are starting to creep up a little bit, are giving us a headwind, are really discouraging buyers. Can't really see that yet, which is good news for the U.S. economy. And so we're going to be looking at these housing-related statistics fairly carefully through the spring buying season. And right now, things are looking in good shape. The new home market, I did notice that the inventories are starting to tick up a little bit. Doesn't mean it's overbuilt yet, but they have ticked up, and that's another thing to watch out for, because I do think that that's the segment of the market that's probably a little bit more vulnerable to rising interest rates than the existing home market, because usually you have more room to negotiate on price on the existing home rather than the new home.